The suppression of gold is not solely the task of the issuers of the world's reserve currency. Other nations and central banks profit from the suppression of the price of gold as well. Therefore, throughout the years, there have been numerous accounts of foreign central bank gold actions that seem to tie in with the gold suppression scheme. You see, the program to cap the gold price would break down without access of some sort of physical gold, such as a friendly central bank willing to step into the breach, either with bullion for sale or with a willingness to lease notwithstanding the risk. The British gold sales and Kuwaiti gold loan, both otherwise without apparent rational basis, fit this pattern. James Turk has built the case that between 1995 and 2000 almost 1700 tons of gold have been swapped between the ESF and German Bundesbank. So by so doing, the gold in the Bundesbank's vault in Europe has become the ESF's gold, and the gold in the German Bundesbank now resides in US vault. This was the reason the West Point vault in the 1990s was reclassified from gold bullion reserve to custodial gold, because the Treasury no longer owned the gold stored over there. The assertion that the US holds German gold was proven in 2009 when Max Kaiser obtained information of the Bundesbank that their gold was in New York. The list of the banks on this slide is by no means a complete overview of the banks participating. I bet there are a lot more friendly central banks involved when we would have a closer look, and more information about central bank practices would be provided to us. So, which particular investment houses are likely to be involved in the suppression scheme? Well, looking at the US financial and monetary history, it should be no surprise when JP Morgan and Morgan Chase were involved. Of course, JP Morgan interests were represented during the 1910 meeting at Jekyll Island, when the plan for creating the Federal Reserve was drafted. This bank has a very special and intimate relation with the US government and Federal Reserve that goes back decades. Then we have large banks like the Bank of America, Citibank and HSBC. HSBC is the official custodian for GLD gold derivatives and therefore has a particular special position. Then of course we have Goldman Sachs. Looking at the amount of former Goldman Sachs employees that currently occupy financial advisory positions in the Obama administration, this firm, like no other, embodies the revolving door between top government and business positions. And Goldman Sachs is infamous too for its high-frequency trading techniques. But can we point to reliable information that indicates the involvement of these banking firms to the gold price suppression scheme? Well, take a look for instance at the allocation of gold derivatives. JP Morgan is the undisputed king of gold derivatives. According to this information, it holds about 78% of all the gold derivatives that are out there. Any market position occupied by just one party of a percentage that large should raise eyebrows. When one party owns the vast majority of shares available to the market, the question comes into view if the price that is set on the market can float freely on the basis of a free competitive market system. When JP Morgan is this party, apparently US regulatory agencies do not need to bother themselves asking this question. But I beg to differ. The charts depicted on this slide clearly indicate that the short positions of the big Wall Street banks in the monetary metals gold and silver are way out of line compared to their short positions in other commodities. As of January 16, 2010, The net short position of gold by bullion banks was 28.3 million ounces, or 802 metric tons, of which 21.1 million ounces, or 598 tons, was held by 4 or less traders, that is US traders. This incredibly large short position clearly distorts the price of gold. As we've seen in the previous chapter, short selling ETFs leads to the double selling of one and the same ETF. What this means is that the money to buy 598 tons of physical gold from the market now is being tunneled to an existing amount of gold that was already bought from the market to back up the claim to gold the ETF holds. So instead of diminishing the gold supply by 598 tons, short sales of ETFs leave the gold supply fully intact. This is the secret to the massive short position of the Wall Street bullion banks, and this is why they are involved in the scheme. So here's the complete picture. At the head of the structure are the US Treasury Secretary and US President. They are not the ones who lead the gold price suppression operation on a daily basis. This is the role of the ESF. The secretive ESF places its orders to intervene on the gold market with the Federal Reserve Bank of New York, which carries out all intervention for the US government, as well as all orders from foreign central banks placed for execution during US market hours. But this approach is still not enough to hide the tracks of the ESF and the various governments who intervene to distort normal market forces. They want more cover, so the Federal Reserve Bank of New York places these government-instigated trading orders with the big New York banks. Because these banks have such huge trading volumes, the logic is that government-instigated trading will be hidden amidst the huge order flow handled by these banks. These banks include JP Morgan, Morgan Stanley, HSBC and Citigroup. This unholy alliance, also known to some as the Washington Wall Street Axis, demonstrates that these two forces are in bed with each other to serve their mutual benefit. So now you have the oversight of the major players of the gold price suppression scheme.